Hey everybody, hope you're doing well. In this video, I'm going to teach you one of my personal approaches to trading ICT. Now, this is basically one of the ways that I trade personally. I have a lot of models on my YouTube channel, but this is the preferred way of trading, the one that I recommend, one of the methods that I recommend, all right? So, when you use this strategy, when you use this model that I'm about to teach you right now, you are always like 80% of the time always going to get 1 to 2. That is guaranteed. Like you will get it. If this setup presents itself, you are going to get 1 to 2 risk reward ratio. All right. So the number one step to this model is that price only moves in two ways, right? It moves from external range liquidity to internal range liquidity, or from internal range liquidity to external range liquidity. So I'm going to explain each and everything in detail. So make sure you do not skip any part of this video because I'm going to share some hidden gems in this video and you do not want to miss them. Do not skip the video. So let me just draw this out like that, and let me just change this up a bit like that. All right. So every high every high and every low is considered to be external range liquidity, all right? And the fair value gap, any fair value gap is considered to be internal range liquidity, right? So if price takes out external range liquidity, it's going to go into the internal range liquidity. This is basically how price delivers, all right? So by that in mind, what we can do is we can make a model around this concept, based around this concept, right? So what is my personal approach? I'm not going to give you different things, like for example different time frames. I'm going to teach you my own personal approach. So this is what I do. I go onto the daily time frame and I mark out the external range liquidity and internal range liquidity. So let's suppose that if price takes out external range liquidity on the daily time frame. So this is the daily time frame external range liquidity, high and low. Remember that. Now once that is taken out on the daily time frame and I have marked out the internal range liquidity, which is the fair value gap on the daily as well, and we have taken out external range, I am dropping down to 1 hour time frame, right? So this is going to be the lower time frame confirmation. The number two part of the strategy is we're going to look for a lower time frame confirmation, and this is how it's going to look like. All we need to see is a market structure shift on the 1 hour time frame. So I'm going from daily time frame to 1 hour, and basically we have the market structure shift. Now the SMT part is optional, although it's going to increase your win rate. So if the order flow is weak, right, and I am not quite sure about the direction of the market, what I'm going to do is use SMT for extra confluence, right? So what I will do is look for SMT around these highs, right? Or what I would do is I would look for SMT on the daily time frame, so around here when the external range liquidity was taken out. Now what it does, it basically just extra confirms your idea, your trade. So the first thing we did was establish a bias, right? So we have taken external range liquidity on the daily, and we have the internal range on the daily as well. Now, once the external range liquidity on the daily was taken out, we need to confirm that we are now going into the internal range liquidity. And to do so, we look for a 1 hour market structure shift. So over here, what do we have? We have a 1 hour market structure shift. Now, the best part of the strategy, and this is going to always give you 1 to 2. Trust me on this, I'm not lying, all right? You have to test it by your own self, because I'm not gonna, you have to go and test it out and then come back and comment, all right? So what is ABCD pattern? I have taught this method before in my old YouTube videos and in the part 1 of my course, but this is what it looks like. So we have A, B, C, D. What exactly is this? We have lower low, lower high, lower low, and then we have a sweep of a lower high. All right. Now, just to give you a different thing, this is what ABC pattern looks like. So we have A, B, C, right? There are two type of liquidity sweeps. This is A, B, C, D, and this is A, B, C. Now this one is a low probability liquidity sweep. However, this one is a high probability liquidity sweep because when we are in a sell program, so for example, I'm looking at a sell trade, right? We want to look for buy side liquidity purge in a sell program, all right? When the price takes out buy side, it's now going to go towards the sell side in a bearish market, all right? So once you get the 1 hour market structure shift, we have established our bias. We have the confirmation that price is now going into the daily time frame fair value gap that is right here. I'm not going to take my entry right now. So what I'm going to do is I'm going to wait for an ABCD formation. Just like that. Perfect. All right. So what do we have? We have a market structure shift, and also we have formed a BCD pattern, right? This is not ABC. This is ABCD, where we have a lower low, lower high, lower low, and then purge of the lower high. That is the high probability continuation liquidity sweep. You must remember that, all right? This is the exact pattern. You should not be looking for this type of liquidity sweep, all right? Like this, or something like this. No, that is a low probability liquidity sweep. What is a high probability one? It looks like this. Boom, like that. And price is then going to go towards the original direction. All right. So once we have taken out the lower high on the 1 hour time frame, right? So we got market structure shift on the 1 hour, and we also formed ABCD pattern on the 1 hour. Now, once the lower high is taken out on the 1 hour, we are then finally dropping down. So this is the fifth pod, which is marked by the question marks. We are dropping down to the 5-minute time frame to extra confirm this trade. And trust me, when you get another 5-minute market structure shift around this level, I guarantee you guys, you're going to basically get 1 to 2 guaranteed, and then price can also go somewhere around here. This is basically my entire approach to trading. One of the ways that I trade. There are a couple more. I will maybe share them in the future, but this is exactly what I use to trade, all right? It works with all pairs, all assets, even with crypto, right? Even with shit coins. I'm not even kidding. This is how market delivers itself. Now, it doesn't mean that you can only take one trade here. So what you can basically do is, as long as the daily internal range liquidity is intact, it is not taken out, we can still keep looking for ABCD patterns. So over here we have A, B, C, D, right? And then you can see we have a purge of this high. So then afterwards, I'm dropping down to the 5-minute time frame to confirm it even further. And once I get that, I'm taking my entry from the breakup block, auto block, or fair value gap, wherever it looks clean to me. And I'm going for 1 to 2, going break even at 1 to 1, all right, or 1 to 1.5. Maybe you can take a little partial, but I recommend you go break even at 1 to 1 or 1 to 1.5 and hold till 1 to 2 and just get out of the trade. And then you basically just hold. If you want to, you can hold it till here as well. But make sure you are break even if you have taken some partials. This is basically the entire model. I'm going to give you guys some examples, and then we will end the video. Okay, I forgot to teach you how to trade IRL to ERL, right? So this is very essential. You have to watch it carefully, and then we will move on to the examples actually. So let's assume that we have a fair value gap here. So that is IRL, right? You would do the exact same thing. So on the 1 hour time frame, you are looking for a market structure shift that is going to confirm that price will now go towards the external range liquidity, right? And then you're waiting for an ABC formation. So it's going to look something like this. And then you're going to have sweep of the liquidity right here. And then you would drop down to 5-minute time frame to look for another shift in the structure, take your entry and target this high first, and then you can have your last target around here. Now, one key thing to note is that using SMT with this from IRL to ERL is quite essential, All right, you have to use it because sometimes you will get faked out, because you may have noticed that price never really moves in this manner all the time, where you have break of structure, price respects the fair value gap, respects the fair value gap. No, if it was that easy, everyone would be profitable. Now, to like 65% of the time, this will happen though. So we have to confirm it with SMT, right? And to do so, we simply use, SMT that would look like this. So for example, on NAS 100, if price tapped into the daily IRL, but on S&P 500, price failed to tap into the fair value gap, then that is SMT. Or it would look something like this as well on the daily time frame. So we have, something like that. Price comes back into the fair value gap, right? So look at this. We have this low, and let's suppose that on NAS 100 we swept this low over here and then tapped into the fair value gap. However, on S&P 500, let's assume, or US 30, let's assume that price failed to take out this low and also tap into it. Then that is an SMT. Now, there's another way to look for SMT. There's a complete video on SMT on my YouTube. I'm going to just put a card over at the top right. You can watch that video and then come back to this video, because SMT is very essential if you want to be trading from IRL to ERL. However, from ERL to IRL, it is not that necessary. All right. But in both cases, it's going to increase your win rate. So just go and watch the video that I've posted in the top right of the this video, and there will be a link in the video description as well. So go and watch it and then come back. So now let's move on to the examples now. All right, everyone. So here is example number 1. So you can see that I've marked out the internal range liquidity over here. So let me just mark it out like that. IRL, right? It's very dark. So let me just, sorry, it's very bright. So, okay, perfect. So you can see we tap into the IRL and we have ERL over here. So that is external range liquidity. Let me just make it short. That should be okay. Okay. So when price tapped into the IRL, right, we want to drop down to the 1 hour time frame. And over here, you can see what do we have. After price tapped into the IRL, we are looking for a market structure shift. And that confirms our bias that price will go towards the ERL that we have marked out. Now look at it over here. We have A, B, C, and then D. Do you notice this pattern right here? Where we have A, B, C, D. Price sweeps the higher low over here. So now once this happens, we are dropping down to the 5-minute time frame. So let's drop down to 5-minute time frame and see what happened. So this is the A, B, C, D over here. And then you can see that just around here, we have another market structure shift. So now we can look to take our entry. All right. And you have this auto block, right? And if we use our premium and discount zones, we can take our entry from the auto block that is below the 0.5 level, right? So we can maybe take our entry from this level right here. This is an entire auto block, but we want to enter in the discount. All right. Well, you can enter from this breaker block or entire auto block as well. But if you really want to be, increasing your risk reward, you can basically enter from this auto block or this over here. And then you can see that we took our entry during the PM session. So usually you would not trade Forex at PM session, but we are trading indices and that's totally fine. We're trading futures. So you can do that. There's a PM session for that as well. All right. So just before the PM session was over, we took our entry, right? And that was a guaranteed 1 to 2. Now I believe that we are going towards these equal highs over here, this original consolidation, because if you go to the 1 hour time frame here, you can see that this is the actual target here, but I am pretty sure that we are going to take out these equal highs over here. So now that we have known how to use IRL to ERL, let's move on to another example. All right, guys, so here is example 2, and I'm showing you recent examples because this happens every single time, like every single week. All right. Out of all these pairs and assets, NAS 100, US 30, and even crypto, per week, you will be able to identify 4 to 5 high probability setups. All right. You do not need to trade every single day. Just take 3, 4, 5 trades per week, and I promise you, you are set for life. So, example 2, USD CAD on the daily time frame. And in this example, we are going from external range liquidity to internal range liquidity. So note one thing, we need to, when we're going from external range to internal, you can see that the actual draw would be the internal range liquidity, which is above the 0.5 level, which is actually in the premium, right? But we always want to target the closest fair value gap, or in most cases, the second one. So you can see we took out this external range. We have this fair value gap as well. But I am 100% certain that price will go into this IRL. Why? Because first of all, we haven't reached the premium here, right? So the probabilities are very high. And secondly, the actual draw, the actual IRL is 0.5, is above the 0.5 level. But since every single fair value gap is a internal range liquidity, we cannot be certain that price will go towards this. Though price will always grow from highs and lows to fair value gaps. It doesn't matter which fair value gap, but most of the time it will go to the one that is above the 0.5 level or below if we are looking for an entry from discount. I hope that makes sense. Please rewind the video and listen to what I say. So this right here is going to be the IRL for me, right? Although this is as well, but I just want to be in and out of the market. I do not want to, target these massive numbers, okay? It's just not worth it, bro, for your psychology and for other reasons. So ERL was taken out. We have this draw. So let's drop down to 1 hour time frame and see what happened. So we take out ERL right here, and then we are looking for a market structure shift that is going to confirm our bias. And if you look closely over here, we formed a lower low, lower high, and then a lower low. We swept this low just around here. And then what we are looking for, guys, remember, we are looking for A, B, C, D pattern, the favorite, the best pattern to ever exist in the, I don't know, man. It's just so powerful that I promise you guys, it's just insane, all right? So let's just go here. So this would actually be your target round here. So let's go to the 5-minute time frame. And notice what happened here. So, okay. After we took this out, you can see that we had this high over here. Now, why this is a high? Because the candle to the left is lower than it, and the candle to the right is lower to it as well. So this is a high. And that gave us a market structure shift. And then we have what? We have a fair value gap around here. And that happened on 28 August. So if you're watching now, it happened on Wednesday. This would have been your entry, and you would target this high over here. That is absolutely incredible how accurate this strategy is, guys. This is one of my personal approaches. If you want to learn all of my approaches, there's a new course coming out very soon. And there's also some approaches in my current course. You can get it. The link is in the description. Of course, this is not necessary. I barely do any promos, but I believe it's worth it for you because we have a community of over 2,000 people and we help each other out. And I give analysis and everything on that server. So if you're interested, the link is in the description. But it's not necessary. I'm giving you what you need, bro. Like, listen, this is what you need, okay? Let me give you guys one more example. All right, guys, so here is last example. And I promise you guys, this is like one of the best approaches to trade ICT. I have a lot of videos on my channel, right? There are different models for different people. So if you are from Australia, I have a strategy for you. If you are from the United States, I have a strategy for you. If you are from Mexico, I have a strategy. If you are from India or Pakistan or UAE, I have a strategy for you, right? I want to give you guys the best models possible and for everyone, not for just one one group of people, right? Not for Australians, not for Indians, or not for Pakistani, for everyone. But this is a universal model, and it's just tradable every single time. Just make sure you're taking your entries during the kill zone hours, okay? So over here, what do we have, guys? We have swept external range liquidity, and this right here is the internal range liquidity. Price does two things: from ERL to IRL or from IRL to ERL. Then we drop down to 1 hour time frame and we look for a shift in the market structure. So this right here is where we swept, and we get a market structure shift right here. Higher high, higher low, higher high. right? We went up, swept this high again, and we pushed down. Now notice, guys, what happens, right? Our draw on liquidity is still intact, and we got A, B, C, D. Absolutely beautiful. All right, look at this. A, B, C, D. Right here. And then we look for a sweep of the lower high that was created. And our target is going to be this. And of course, the higher time frame target is going to be this. But I'm telling you, just take all of your profits here, or just 1 to 2, as I said earlier. So dropping down to 5-minute time frame, and just look at this precision, guys. Okay, during the New York session, we get a higher high, higher low, higher high, a shift in the market structure. And what do we have here? A beautiful fair value gap. When people say, oh, fair value gaps don't work, because you are not using them in the right context, bro. When you are using the fair value gaps in the right context, they're always going to work. So your entry is going to be from this fair value gap, stop right above the high, and you are targeting this low over here. And you can see right when this target was hit, we pushed up. So basically, in a different term, this is all market maker models. We have original consolidation, we have smart money reversal, and we have the market maker sell model, right? It's all market maker models, but this is it, guys. Literally, this is all you guys need. Thank you so much for watching. Please hit the subscribe button, and please like this video if it works out for you. Of course, this is going to need some practicing. Go back test, go paper trade, and this is all you need. This might be the best video that I've ever created, and this is model, right? It's just perfect. It's one of my models. I have other ones as well, and this one, it's just going to work for you. Trust me. Yeah, goodbye. Take care.